Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to discuss some breaking news, which is that the G7 has reached an agreement around a global minimum tax for multinationals. So I'm going to dive in and tell you a little bit about what that means, how they're talking about making it work, how they'll enforce it, what I think it means in terms of tax planning for you, in terms of the future of what's going to happen over the next little while, the whole concept behind it, etc. So before we do that, if you haven't already, please smash the subscribe button, nail the notification bell. Really appreciate your support subscribing. And please, if you have any questions at all about these topics of international corporate structuring, personal structuring, so pay the lowest legal amount of tax possible, get second citizenship, second residencies, open bank accounts, form companies, get payment processing, etc., help on the implementation or the strategy side, please reach out to me. You can book a call, calendly.com/Michael-Rosmer, link in the description below, or send us a message through offshorecitizen.net or offshorecapitalist.com. Okay. So, I'd done a video about this a little while back. It was not surprising. Janet Yellen, the new Treasury Secretary of the US, had basically made clear that she wanted something like this to come into place. So first of all, let's just ask the question of why it is that they have brought this in. And I think that the biggest thing you need to understand is the global tax environment and how things have been changing. So just kind of from an equity standpoint, being totally reasonable here, a bunch of countries have been kind of getting screwed. Good example of this is Starbucks has clearly been operating around the world and was operating in UK, was not paying any tax, and it ended up being a big backlash about them. Now, notice, it's not that they weren't paying any taxes, they weren't paying any UK tax, right? So they said they'd voluntarily pay some tax in UK to kind of avoid the backlash. But I think if you have a company operating in your country and profiting off your people, and you're getting no value from it, there's a justifiable desire to feel kind of upset. And currently the tax rules don't tax typically based on where customers are, and this is bad for certain countries. So for example, China has been ripping off the US for years and years, basically just extracting financial value from them, because basically the US is the largest consumer market in the world, and so people are spending more than they are getting in reciprocity. Now, of course, US innovation has led, and that's been kind of a positive thing for them, etc. But anyway, this has been the case. What has changed in recent years is not that country or companies get to choose where they pay taxes or things like this, but that some countries have brought in some specific taxes designed to target some of these companies. So UK, being a good example, was bringing in a digital services tax, so specifically, or digital transaction tax, something like that, I forget what they call it. Anyway, specifically targeting companies like Facebook, like Amazon, etc. And the US didn't like this, right? Basically, the US said, hey, listen, basically for a long period of time, other countries have been, in particular the EU, they're, kind of forward-leaning in this sort of way. Don't know if I'd call it forward, but anyway, they tended to lead the charge on these tax reforms. They were saying, hey, listen, they wanted this global minimum tax, or at least I would say Western Europe, obviously Eastern Europe, not so much, Southern Europe, it depends where. They were leading it, but they didn't have the cooperation of the US, which was kind of needed. This has kind of triggered them to suddenly come on board and say, hey, listen, we don't want tax competition. I think tax competition is great. Competition is good for the market, and to try and eliminate competition, monopolistic practice, very anti-free market, anti-capitalist, but anyway, is what it is, I guess. So, basically this was a bargaining chip, because as part of the deal, they negotiated that these other countries are going to get rid of these taxes that are basically targeting major US companies, okay? So notice how there's been this political play here, okay? That's one thing. Now, as for how this works or who it will affect, fortunately it will probably not affect you, because as I have read it, now we'll see what they actually come up with in real implementation. I tried to dive in and do some research on the specifics of it and couldn't find anything really meaningful. But what I was reading previously in the proposals was we're talking about, I think it was $750 million a year in revenue or greater, and with a certain sales nexus within that country. So it was like 50 million or something a year in a given country. So you're probably not going to be affected by that yet. Now, frankly, I think they'll start big and they'll gradually work their way down, or inflation will work your way up. One of the two, maybe a combination. will get you there eventually. So this will be an introduction, and that's likely going to be what's going to happen. The question some people have had is, well, hang on, how can they enforce this? How can they impose it on a country like UAE or something? Well, the answer is quite simple. They simply say, hey, listen, if some other country isn't taxing them, we will, right? And so now all of a sudden what they do is they create an incentive where, let's use the real obvious example, which is Jersey. Apple has moved a lot of their companies to Jersey. So, you know, Jersey is a zero tax jurisdiction. They say, oh, well, if Jersey's not going to tax them, we're going to tax them over here. Now, this is a weird thing to me because technically speaking, they could already do this through CFC rules. Like that's basically how GILTI tax works in the US. If you don't fall under the high tax exception, which is 18.9%, then you're subject to GILTI rules, GILTI tax being 10.5% at the moment. So I'm a little bit confused how they're going to coordinate this, like who gets to choose the income. The OECD has been really more forward thinking in this regard of instead of trying to do what they call Pillar 1 and Pillar 2. So Pillar 1 is figuring out where companies pay taxes. And this was a really hard thing to do historically, right? Historically, if you think about it, companies pay taxes based on where they're resident, based on where their operations are. This kind of made sense because you could police that. Difficult to police where the customers are. So you're going to have to figure out some way of calculating that, a little bit like they do with VAT. So we will see. Anyway, that's how that goes. What does this mean for you? Well, I think what it means for you is a couple different things. First of all, you know, at least for the moment, if you are not considered to be a multinational, you're going to be able to escape it. Now we'll see how countries rather change their tax policy based on this. I was just reading an article about how, you know, Guernsey may face some challenges in here because Guernsey is largely a zero tax country from a corporate standpoint. So that'll be interesting. The other thing that's going to happen is you're going to pay more attention to your personal taxes, which is kind of the opposite of what we do today, right? Usually today, I have clients all the time who I'll say, hey, listen, you can stay in your home country. You can live in Canada, you can live in Australia, you can live in New Zealand, you can live in the UK. And maybe you can't get away with zero personal tax, but you can get away with zero corporate tax. What will the situation be? The situation will be, okay, well, maybe I can't get away with it at the corporate level. So instead of paying myself dividends, I'll pay myself wages. This could end up making a place like UAE more attractive because they have that zero personal tax. A lot of countries have favorable corporate tax, but not personal tax rules. And so this will be interesting to see, you know, does it trigger some changes in various different countries to raise corporate tax? We obviously saw that with places like Andorra over the last little while. Kind of the pressure from Spain and France kind of drove that in there. So we'll see. But the out, kind of looking down the road far enough, is you'll want to be able to take income personally rather than at the corporate level in order to stay ahead. Obviously, there's some downsides to this, and I mean, there's downsides to it both ways. But that being said, that will potentially be an area of planning. The other area of planning will be to say, okay, great, I'm going to set myself up so that my company or companies are not considered to be multinationals or don't have a sufficient nexus in those countries to trigger any sort of rules. And there's some tricks you can use in order to do that. So as per usual over the last few years, it will possibly make planning more complicated. It will, you know, narrow the number of options that you have, and it'll be interesting to see where the money goes as a result. So anyway, that's kind of a quick summary. If you have any questions about it, please put them in the comments below. If you would like help with, you know, international tax planning, like I said, all these different topics that we deal with here on this channel, first of all, go check out our other videos. Really appreciate, you know, if you check them out and give us your thoughts. If you like them, give thumbs up, share them with your friends. We're trying to grow the channel. And if not, then, you know, you would like some personalized advice, reach out to me. I'm going to look forward to seeing you guys on the next video.